morning and welcome everyone to the fourth webinar in the Building Financial Resilience series. Today's session will be about planning and strategy masterclass in exiting your business. Whilst we're waiting for people to come in, I'm just going to start with some housekeeping. In the background, we have Holly, who's manning the technical side. She's going to be on hand if you experience any technical difficulties. And if you have any questions, please pop them in the box. We are recording this webinar, so it'll be sent out to you on record, and you can watch it on demand on our YouTube channel too. Please feel free to share this with your colleagues, your peers, or your network, because they might also see some value in this. So, okay, we have 45 minutes for this session. It's going to leave us plenty of time to do a Q&A at the end. And if you have any questions, there's a question box at the top of your screen. It should send it through to me, and I will take a look. And as we go through things, I'll pose these to our experts. If we haven't got time, there's an opportunity for us to follow up at the end. But the Q&A session will be a real opportunity for you to have your questions answered. Okay, so I am your host for today. I am Lucy Sanderson, and I am MPA's marketing manager. We have two expert panelists today. We have Richard and Ravi. Shall we kick off with some introductions? Ravi, would you like to go first?
Sure, thanks, Lucy. Morning, everyone. So I am a chartered accountant. I originally trained with EY, spent most of my career in sort of corporate finance or transaction roles. But the last 20 years, I've been specifically working with SMEs, mainly in transaction work to do with acting, advising buyers and sellers on deals. So that's me, really.
Great, Richard, take it away.
Take it away. So hi everyone, good morning. I'm Richard Lupson-Darnell. I'm the Corporate Tax Manager at MPA. I am a Chartered Tax Advisor and have been advising SMEs for the last 20 plus years on everything transactional to do with the lifetime of their business. So all the way through to how do we structure in the first place, through various events that you will encounter along the way outside of the day-to-day, and also on exit planning and making the most of opportunities as they come.
Thanks both. It's a real pleasure to have you on here today. So, what we'll be covering. So in today's session, we'll be covering why it's important to start exit planning early. We'll be also talking about the best time to sell your business and how to identify potential buyers. They'll also cover how to structure the deal for maximum value. And then at the end, we'll share some tips on how to avoid common pitfalls in exit planning. Throughout the session, the team are going to share some examples from their experience, and at the end, there'll be an opportunity for a Q&A. Right, so running a business is a journey. I'm sure you all understand this and have had many experiences along the way. But let's look at what the last 12 months to 2 years have been like. The macroeconomics of the past few years have presented a real tough environment to survive, let alone thrive. The increased interest rates, the cost of living crisis, and we're even living with the legacy of Brexit, the COVID pandemic, and dipping in and out of recession. So what does this mean? This actually offers us an opportunity for entrepreneurs and business owners to make or revisit their exit plans so they can align their strategies. And what we want you to really take out of this session is that understanding that your final destination will be impacted by the decisions you make along the way. So before we jump straight into the webinar, Richard, Ravi, I read a report from Charles Stanley. They did a survey back in October 2023, and it revealed that almost half of business owners, and that was 48%, have no exit strategy in place. This is quite a stark number. Before we jump in, I'd love to get your view on why this could be the case.
So shall I go, Richard? So I think the key thing to understand is that the world, the business environment, your personal circumstances are always changing when you're running a business. And it's really important to think about the future, what your plans are, where the journey is going to end, if at some stage it is. Well, it always does in the end. But most business owners end up, in my experience, spending so much time sort of firefighting day-to-day operational issues that they can never actually look at the business itself and their own personal goals, their business goals, etc., and actually just reflect more than anything, reflecting on what the business has to do for them as well as what they have to do for the business. So change it brings risks, it brings opportunities, but it's always a good time uh, to consider what could happen, what are the benefits of that change, whether that be in the world environment, the business environment, or your personal circumstances, indeed.
Mhm. Yeah, I agree with that. I think it's always good to have it on your agenda. If you had a rolling agenda for every meeting you have, board meeting, um, and you don't have to visit it every time, particularly in the early years. Obviously, you're trying to get your business off the ground, and that's you want to have something to sell or exit from. So I think it's just having it always there as something that you have as a reminder to think about. From time to time, it will become to the forefront, and increasingly as the business matures. So yeah, that figure is very stark. From sitting here as an advisor, we obviously clearly would want most of our clients to have a view as to where they're headed.
Absolutely. So let's get stuck into the session. So we're going to do a question-based session. And the first question I have is really around, why is it important to start with the end in mind? Ravi, would you like to go first?
Yeah, sure. So people start or go into business for a variety of reasons. It could be there's an opportunity that opens up. It could be a change in lifestyle that they want or determine, or a passion to do something different. But it's absolutely vital at all stages to think about goals, personal goals, business goals. Why did you do it in the first place? What do you want at the end of it? And so there's got to be a plan. And I think, that's the critical bit about when we say the words business plan. A lot of owners sort of turn their face and think, there's going to be a document like War and Peace, but it's not about that. It's about actually understanding where your journey is. So the journey is a route from A to B. You're going to get, hopefully, from you start off on A, you're going to get to B. Another stark statistic, by the way, 80% of startups fail in their first year. So that puts into light that, how important it is critically in that, especially those early stages, to have a really good detailed plan so that you could be one of the 20%. But I think the best analogy I would give is it's a bit like climbing Mount Everest. You wouldn't turn up at base camp and then say, right, I'm just going to start meandering because I want to get to the summit at some point. You need to think about, the conditions, the weather, the support team you're going to need, the route that you're going to take. And it's exactly the same with a business. If you know this is where you're starting and this is where you want to go, it's a lot easier to navigate that route.
Absolutely. I think I have little to add to that, apart from it comes back to keeping these things on the agenda, yeah, and having that strategy mindset as alongside your need for day-to-day survival and thriving, hopefully eventually. So yeah, it's never too early to
And
start.
it's not. I don't think it's also something that is just a document that you pick up and then put away again. As a business plan, it's something that you need to revisit because life changes, your personal circumstances change, your business changes, the government changes. There could be all reasons why you want to revisit it, and it's really important to keep revisiting what those personal and business goals are.
Yes, that's the case. Richard, you had a client that had a life event that happened. Would you like to share a brief overview of how that impacted them?
Yep. So two business partners owning a business started 20 years ago. one slightly older than the other. Let's say it's 10 years between them, and they both got their respective spouses involved as shareholders as well. So there's 4 shareholders, but equally between the couples. And so the older one has reached a point where he's looking to retire and wanting to get out of the business. The other founder partner wants to carry on for some good time, and has no interest in departing. So what would we look at typically in that situation is, is there an ability for one to buy the other out? There is a mechanism called where the company buys its own shares back off the one who wants to leave. But you need to have reserves to do that. They have reserves, but it in no way meets the expectation of the departing shareholder. So you have to park that one, which means that they're now looking at an external sale. They've not really identified along the way, which is something we'll come on to, who could possibly buy them. So the only way to solve this is they've had to get somebody involved externally as a broker who's doing that job for them.
Brilliant, thank you. Let's move on to the next question. Okay, so when is the best time to sell your business?
Richard, shall I go? Shall I go on this one?
Yeah, go on.
So a bit like a very political answer that we're all getting used to at the moment, but there's no set rule. It depends. There is no set timing for anything. What I think most owners need to consider is maximizing value and the timing for maximizing value. And very often, the most important factor in that is the time in terms of, is the business on an upward trend? Is it growing? Does it have a good reputation in the marketplace? Are employees all happy and customers are happy, etc.? So it's going upwards rather than either plateauing or declining in terms of financial performance as well. So that will give an opportunity for for getting top dollar for your business, if you like, as opposed to entering a transaction because you think I'm desperate to get out, and everyone knows that you're desperate to get out, and the business is in decline. You're not going to get. It's more like a fire sale, so you're not going to achieve strong value. It could. There's other factors though. It could be that from an industry perspective, there's a lot of consolidation or acquisition activity in the market, and that means there could be a shortage of, say, businesses like yours, and a lot of demand, which again means that it's more likely that you'll achieve better value because there's, say, a shortage of good businesses in that sector, and buyers are willing to pay more for them. So that could actually change what you consider to be the best time. You might have thought it'd be 3 years, but actually it might be 12 months. So it depends.
Absolutely. So I think one key thing along the way is for you to completely have a handle on your industry. I think it's vital that you understand the sector that you're in trying to determine that. So how is the sector doing? The economy might be doing one thing, but how is your sector performing? The analogy that I've thought and used in this scenario is where take the Apollo missions going to the moon, or any rocket that's going up. One went up yesterday, and to get out of the atmosphere takes a lot of energy, and but to then do the mission, which typically will be outside of the atmosphere, going somewhere else, say to the moon. So what's the moonshot? Is that you need to jettison some elements of your business. But in this scenario, in terms of the best time, using this curve, the best time is after you've just left the atmosphere. Yeah. So you've still got a good part of your journey to fulfillment there. And it's something, it's the tension is for business owners is that they're saying, well, you're telling me that I'm going to have to leave some value on the table, that I'm going to, for somebody else to take. But that's the tension, is that there will be a middle ground. There will be a point where it's good for you. You're maximizing your value whilst they're maximizing their potential upside.
Thank you. We seem to have a question come in. You spoke about the economies doing one thing and the industries might be doing another thing, and you have to take both of those into consideration with selling a business. But what industries are currently not in favour, and what can a business owner do if the industry falls into that category? Ravi, would
Good question.
you like to take this
Yeah,
one?
it's a good question. I mean, in my experience, most industries, not all industries, but most industries, they tend to go through a cyclical wave of being in favor or out of favor, depending on where they are. So most things will go up and down. So if you're in a sector which is maybe slightly negative at the moment, it's not the end of the world. Hopefully that will change in time when things can happen and events. So a good example of that, I think, at the moment, the sector that comes to mind is hospitality. It's generally not sought after at the moment in terms of values and the number of deals, number of transactions, largely driven by everyone understands that, if you go to your local restaurant, you go to your local pub, they're struggling with things like energy costs, staff shortages, staff payroll, people working from home a lot more, so not necessarily going out as much, etc., etc. So that at the moment would be, I think, a sector that is not necessarily commanding the best values or valuations, but that changes, and it will change. And it's if you're in that business, it's important to understand how do you become better than your competitors in that field to maximize your value of your business. I've worked in other sectors like healthcare that have been private healthcare that have been through a very poor sort of situation where things like public sector funding collapsed in 2012, and they were largely deemed as very out of favor. A lot of owners sold up of different types of care businesses. And then 5 years later, lo and behold, valuations were achieving higher than they were in 2012. So 5 years prior to that. So that they can swing and change. I mean, obviously, there will be some industries that completely go because of technology, changes technology. But generally, I think it's a case of they're cyclical and they can move. So it's if you know that you're in a business that is actually in a very excited state, it could be a good opportunity to consider what your exit planning strategy is.
Great, thank you. Let's move on to the next question. Okay, so types of and how do you identify the right one?
We just lost you for a second there, Lucy. But Richard, do you want to go on this one?
Yeah. So different types of buyers. I think and this is why it's good to be attentive to not only what's going on day to day in your business, but what's going on in your sector. Because the headline for me is that typically you will already know the people who are going to buy your business. So that could be an interested party who's invested in your business to an extent, but typically it's going to be suppliers or customers or somebody else in your industry network. If you network on an industry level, people will become aware of you, even if they're not a customer or a supplier. So you will find that you already know them. So it's being attentive to that, working backwards. How do you identify them? Is being active in those potential marketplaces, which may well be it's good for you on a day-to-day business level anyway, because it's generate turnover, and people can feed in as a supplier. but it's then widening that net for people who know who you are, what you're about, and they, people of a certain type are always on the lookout. So they're potential, external buyers. You can also have internal buyers. So you could have employees. You could have built up a management team who you get to a certain stage where you want to incentivize them, but then ultimately with a view to them taking over. So there are various ways that could happen, through share schemes initially, but also through just being minded that that's your exit, with or without external finance. It depends on their situation as well. And also going back to the example I used, what reserves you have in the business. So there are many different aspects as to that could feed into enabling it to happen, which then feeds into what type of buyer you may have. Ravi?
Yeah, I think I agree completely, and I think on going back to that point on sort of what we call in the trade, so it could be customers, it could be suppliers, competitors, even. I think what Richard said is absolutely right, and I think I think one of the things I would say in running any business is make sure that you treat everyone professionally. Your business relationships are solid with integrity, because you never know where a buyer's going to come from. A good example I've got of that is I sold a business once which never went to market. I was speaking to a banking customer relationship manager, and he in fact knew another client of his that was looking to expand, and the transaction was done without actually ever going to market. So saving a hell of a lot of time, money, etc. So there's advantages in certainly keeping good, strong relationships in the trade and having a good reputation for that. I think the other type of potential buyer or exit strategy is to other than employees and management is private equity. So sort of professional buyers who look to either take a minority or a majority stake in your business, or indeed all of it, in terms of the shareholding. But they normally go through a very well trodden sort of exit process if they're interested. They have their own what they call IRR, which is internal rate of return hurdles to achieve, and if they can achieve those within a time scale, then they could be interested potential buyers, and they offer something slightly different to a lot of other to trade or to employees, for example, in the sense that they may allow you to take some value off the table today, which can appeal, especially in the SME world, but actually keep a shareholding for future value. So in other words, if the business carries on growing successfully, in a few years' time, you might get some more value off the table for some involvement in helping the business navigate through that route. So private equity has its pitfalls as well, though. One of the other things that we often mention is that they will often want a seat at the top table. So a lot of SMEs have owners or directors that are used to running their business, and suddenly there's somebody sitting alongside them saying, "Wow, I don't think that's what we want to do." So a lot of owners struggle with that, but that's not always the case. So yeah, that's my take on the various buyers.
Brilliant. Thanks, both. Let's move on to the next question. So the next question is, the next question is, so you're at the stage where you've got an exit process. How do you structure the deal for maximum value?
Richard, do you want to go start?
Me? Right. So let's come from a tax perspective. To start with, it's making sure that you've got your ownership in the right place. So and that comes back to planning a number of years out as well. Okay. At the moment, bearing in mind we've got an election around the corner, potential change of government, and albeit they've all signed up to headlines of having the same tax rates across corporation tax, NIC, income tax, and VAT. Nobody's said very much about CGT, but CGT is pretty much where we're at in terms of tax planning for maximising the value to you which basically means how much cash do I end up with. So it's making sure that the shares are in the right place, making sure that you're maximising potentially your exposure to, or your ability to claim what is now business asset disposal relief. Many of you will know that as entrepreneurs relief, currently 10% on £1 million. That inevitably is going to change one way or the other after the election when we get around to a budget, whoever wins. So it's making sure that, as I say, you're maximising that situation, whether that might be around your family or with employees and other business partners. The reason for saying there's a timescale is that at the moment you need to have a 2-year window of qualifying for that prior to the sale. So you can never predict when the sale is going to happen, but you can make sure you're qualifying for that very, very valuable relief. So that's the headline from a tax perspective for maximising value. You also need to bear in mind that many businesses buyers will require you to stay on and for a period of time to secure the transition, be that for customers, suppliers, for whatever reason, to make sure that it's bedded in with new ownership. And therefore they will want to structure the deal with an earn-out element. That earn-out element can be structured very favourably from a tax perspective. So having your advisors involved at an early stage in negotiations is vital, just as it is throughout the thought process when thinking about exit planning.
Yeah, I think.
Oh, sorry, Ravi. Just to jump in, we've had a question come in.
Okay.
How do you qualify for entrepreneurs relief?
Okay, so the headlines are, let's talk about shareholders because that's what most people think of. There are other business ownership types that you can qualify, but if you own more than 5% of the shares, okay, and that means rights to assets, votes, and yeah, so more than 5% of the share, 5% or more of the shares in a company for more than 2 years, and you are an employee or director of the business. Yeah. There are also rules for the company and what it does, but if it is a predominantly trading company, the vast majority of what it does is a trading activity, then you should be okay. When you start moving away from any of those, we have problems.
Thanks, Richard. Ravi, I cut you off. Did you want to continue?
Yeah, it was just really in terms of structuring the deal. I mean, each sale or each deal is different, but essentially there are, you could be talking about 100% of cash up front. You could be talking about deferred consideration over a period of time, or as Richard pointed out, an earn out, which is sort of based on consideration dependent on future financial performance. I think the really important thing in terms of maximizing value for business owners in the SME space is thinking about, is their business a clean business? And what I mean by that is things like fully compliant with legislation. So that could be financial, it could be tax, it could be legal, it could be health and safety, anything that comes into them. Because if somebody does want to buy your business, you're going to go through scrutiny, which in the trade is called due diligence. So some form of either financial, legal, commercial due diligence, where they're going to test your business and see what the past is, try and find the skeletons in the cupboard, if you like. But the other thing to mention here at this juncture is that it's not always for owners just about maximizing value. It could be, for example, is the buyer a good fit for the future employees that are going to remain with the business? For a lot of SMEs, their business is their world, it's their baby, if you like, and they want to make sure it's passed on to somebody who's going to treat it with the right respect and plans for the future. So it's not always just financial value for owners that owners do. Obviously, that's very high up in the ranking, but there are other considerations to be made.
Absolutely. I do have a question here. So how is a business typically valued?
Okay, Shall I go on that one, Richard?
Yeah,
So,
go.
so
Yeah.
there's no. I mean, very often people talk about valuation in terms of um, multiples of profitability. Uh, the quoted term normally in the financial world is EBITDA, which is earnings before interest, tax, depreciation, amortization. But it's a multiple of that. It can be multiples of revenue because you can sell a loss-making business if people are excited about what the future holds for it. So it's not always just on profit. But very often that's how people do determine value. There's other ways. There's could be assets, etc. But the important thing to understand is in terms of maximizing value, it's actually things that are a bit softer sometimes. It's things like customer reputation, customer relationships. It could be employee turnover. A high staff turnover indicates that employees are not happy in the business, etc. So sometimes there's other key performance indicators other than just profit, which can impact value. And actually, sorry, just thinking about that, also the industry sector. So when we mentioned before about how sectors go through being in favor or out of favor, if you're in a sector that happens to be in favor at the moment, the chances are you're going to get a higher multiple or a higher value of for your business.
Thanks. Okay, let's move on. So we're I'm going to ask you both in this section to just give us your top tips on how to avoid the common pitfalls around exit planning. For our audience, you'll see on screen what the common pitfalls are, but I'm going to ask Richard and Ravi to just give you their high-level tips.
Okay, shall I go first?
Yes,
Yeah,
Go
please.
for it.
I'm homing in bottom right. It's vital to talk to your advisors all the way along. Yeah, and from startup, because you inevitably conversations around structure, all the way through to that pre-planning for exit when you've got your plan set. Um, there's nothing like an early conversation. I can sit here and say that from our perspective, we always do things on a fixed fee basis. So there's never a clock running. Typically, there's not a clock running as there might be, which might make you pull back from talking to professional advisors. And that's the tension, especially in the early years when you're fighting for the survival of the business. And yeah, you think, well, do I pay somebody for advice, or do I rein back from that? Well, I would suggest that you at least ask for the advice, at least have the conversation, because the best conversations we have with clients and potential clients is where they start by saying, I'm thinking of doing this, rather than I've done this. Can you help me sort it out? So yeah, professional guidance, conversations all the way along. Build those relationships as much as any other for your business, and it's in our interests to see you succeed. So don't erect a barrier that says I can't afford this.
Brilliant, thank you. It is about being comfortable, isn't it? Because of the open conversations that you have to have together.
Absolutely.
Yeah, can
Ravi, what?
I? Yeah, if I can jump in, and I'll focus on Richard's gone bottom right on the left-hand side of the columns. I think we've already discussed it on this in this webinar, but inadequate planning and preparation, it's unbelievable and probably not surprising to a lot of people, but actually most business people are so involved in the day-to-day firefighting operationally, they never actually consider where the business is growing, or where it's going, what the plan is, and you can never prepare too early for some form of exit plan, be it 5 years time, for example, or 10 years time when you plan to retire. It's good to know that that is the plan and where do you hope to get to at that point. The other thing is, and it's the bottom left, the poor financial documentation, records, KPIs, knowing your numbers. It's the biggest thing, I think, for any business. You can tell a business that's well managed, if you like, because the owners know their numbers. They know where they're doing, they know what their P&L looks like, where their profitability is against their budgets, why they're not achieving their targets, what their KPIs are like compared to their competitors. And that is, it's easy to just say, oh, that's just a financial performance indicator, but actually that's what buyers are going to be interested in. How are your KPIs set against a field of competitors? Because that's going to make you more attractive. If you, going back to one of the bits that I talked about in the last slide, was things like staff turnover. In a lot of industries, that is a critical factor in buyers' decision making, because they just know that actually a high turnover of staff is really bad for their clients. So if you can prove that you're at average or above average or better even, then you've got a much higher likelihood of selling your business. So all of that goes back to and points to that bottom right one, which is Richard's just talked about, which is having somebody independent who can actually help you to try and guide you in the early stages of running a business, so that you then end up in the best possible place when you come to exit.
Thanks. Okay, so I'm going to open the floor to questions from our audience. We've got a couple of minutes left, so we've already had one come in, which I responded saying we'd pick up in the Q&A, so thank you for that. And the question is, business angels, what about these? Will it take a lot of time to identify the right angel?
I think that my favorite saying, it depends. If you're looking, it depends. You've got to ask yourself. I think you have to take a step back from that question, which is, what are you looking for? If you're trying to identify a business angel, what are you actually looking for? Is it startup capital? Is it because you've got this great idea and you want to start a business in it, but you want somebody to fund it? Then you should actually ask, what do you need? What is the financial need or requirement? So it's a bit like sort of Dragon's Den. Somebody might say, well, most people might say that sounds far too risky. So if you can just do to a small degree and operate it yourself out of minimal cash without getting in any investors on, get some money, you might then be in a better position. So I think instead of the question being, I understand it, but instead of saying, how quickly can I get an angel, who is it, you should actually think, what do I need? So the plan should be, I need X thousands of pounds over this period of time, because that's what I need to set up. That's what I need for working capital. Right. How do I best go about achieving that? And it might be that business angels can be some family or friends, for example, who are interested, or someone in the sector who thinks, actually, this guy knows what he's doing, or this woman knows what they're doing. I'm gonna give them a chance with some risk capital. So I think that I would advocate, do a plan, even if it's a 1-pager or a 2-pager. This is what I want to do, and then ask professionals to say, what do you think the best way of starting up or fundraising would be, or getting an angel, which may be where you get to getting a business angel.
Thank you. Okay, Richard, I think this one's for you. What tax considerations should you keep in mind when exit planning?
Right. So they're the ones that cost you, and there's the ones that cost you. So by that I mean the ones that will dictate how much cash you ultimately have after you've exited from selling your interest in your business. But then there are the ones which Ravi's alluded to, which is due diligence related, which is basically having your house in order. And if a business comes along looking to buy your baby, then they're going to want to know that you have been completely compliant, because typically they're going to buy your company, which means they sit in your shoes for anything that comes out of the woodwork. So let's say they have a big firm who's come in to run the rule over your affairs, then whatever their headline price is, the role of due diligence, to be slightly cynical, is to potentially find things which can chip away at what that headline price is. So therefore, it will cost you if you do not have all of your ongoing compliance in order. So that means doing your returns on time, paying your tax on time, dealing with any revenue inquiries in an orderly fashion, and being able to point to that and have a body of evidence. So there is an argument sometimes for doing that due diligence exercise as part of your planning, so that you know exactly where you are before they then come in. And also that becomes a body of evidence so you can provide them with. So there is that that ongoing cost. So get your house in order, and then from a tax perspective, to do with the deal is making sure that you've structured it in the best possible way. There are pitfalls like, oh, all of a sudden 6 months out, I've decided that I want Mary, who's been my office manager, to share in the proceeds. 6 months out, that typically will mean an income tax issue for her, not a capital gains tax issue. If you think about that 3 years out, there's things you can do about it to make it more favourable for her, let alone your own situation and that of your family.
Thanks, Richard. It seems that we're running out of time for questions, so I have a couple that have come in, but we can answer those and share them afterwards. So we're going to round off the session. The team at EFM are going to be offering a free financial health check to all the session attendees. You would have heard from the two on the call today that it's vital that you understand your KPIs, your business plan, you revisit your strategies. This QR code takes you to a short survey where you'll answer a couple of questions and you'll gain some valuable insights based on your results on what steps to take to gain better financial management. It's a really valuable tool, very insightful. But what also is on offer is once completed the survey, you can unlock a 30-minute free consultation with an external FD. So you might already have an FD in place, or you might be an FD. It will just act as a soundboard from external position. And of course, if you need to speak to Ravi or Richard, their contact details are on screen. So please reach out if you have any other questions. To summarise the session, I mentioned earlier that running a business is a journey, and understanding your final destination, and in this case is your exit plan, will help you navigate the decisions along the way. Are you in that 48% that have no exit strategy? If you aren't, how do you know your exit plan is right? We're here to help. So I want to thank our experts. It's been an absolute pleasure to have you on the call today, and also our attendees. Thank you very much.